Hello, welcome to our Tulane University Fall 2015 Birken Road Report on continuing coverage of Evolution Petroleum Corporation. My name is Zamir Luna, and I'm representing my fellow analysts Margaret Bishop, Shannon Vetrano, and Thomas Willen. Our analyst group gave Evolution Petroleum a rating of market outperform with a 12-month target price of $7 per share, which results in a 17% return from the current price of $5.98 as of November 6, 2015. We arrived at the target price by using the PV10 valuation method. During this presentation, we will cover a brief overview of the company to include an introduction of the top management as well as key financial ratios. Next, I will discuss our valuation method, followed by an oil and gas industry analysis, a comparison of the company with its peers, an analysis of the risk in this industry, and we will conclude with our own investment thesis for Evolution Petroleum. Headquartered in Houston, Texas, Evolution Petroleum is considered an upstream exploration and production company with an emphasis on production. They use tertiary recovery to extract its reserves using advanced extraction technology instead of conventional vertical or horizontal wells. Evolution Petroleum was initially founded in 2003 under the name Natural Gas Systems Incorporated. The company went through a reverse merger in 2004 with Reality Interactive. Natural Gas Systems absorbed Reality Interactive's assets and technology patents when the company ceased operations. In 2006, Natural Gas Systems renamed itself Evolution Petroleum to better reflect its business operations, which included oil, natural gas, and an emphasis on technological innovation. The Delhi field, located in northeast Louisiana, is Evolution Petroleum's main source of revenues. It was acquired in 2003 at a substantial discount due to minimal oil and gas recovery from primary and secondary methods. Since the acquisition and input of tertiary recovery methods, the field has seen a large increase in production that is projected to increase yearly until 2020. A current significant project at Delhi is the construction of a natural gas liquids or NGL plant that will extract both NGLs to be sold in the market and methane to power the field, which will substantially reduce operating costs. In 2006, Evolution Petroleum sold the mineral rights of the Delhi field to Denbury Resources, while retaining a 7.4% royalty interest. The contract contains a unique reversionary working interest that significantly benefits Evolution Petroleum. After Denbury Resources realized $200 million in net revenue from the Delhi field, which transpired on October 2014, Evolution Petroleum began to receive a 23.9% of revenues and costs associated with operations of the field, resulting in a total of 26.5% aggregate interest. The table displayed shows Evolution's net share of the Delhi field's production and forecast. Notice the spike in Evolution's share at the time the reversionary interest took effect. Evolution Petroleum's main technological comparative advantage is its gas-assisted rod pump technology, or GARP for short. The technology, a type of tertiary recovery, pushes carbon dioxide into a well, increasing the pressure of the underground cavity and allowing for otherwise dormant oil and natural gas to rise to the surface. Evolution currently uses this technology, but it is also being marketed to other upstream E&P companies with a leasing contractual relationship for the technology. Evolution Petroleum's management team boasts an average of over 25 years of experience in the oil and gas industry. Robert Hurlin, in addition to being chairman of the board and CEO, co-founded Natural Gas Systems in 2003 and has over 30 years of experience in the industry. Randall Keyes has been with the company for 2 years and has over 30 years of financial leadership experience in the upstream and oilfield services industry. Daryl Mazzanti joined the company in 2005. He has over 30 years of engineering experience and is a former business development manager for Anadarko Corporation. David Joe also joined the company in 2005 and has over 28 years of energy accounting experience. Evolution Petroleum's financial ratios are as follows. Its earnings per share are 19 cents. Its price to earnings ratio is 31x. It boasts a 3.34 dividend yield. The company has a market cap of $192 million and an enterprise value of $175 million as of November 21, 2015. The company's proven reserves are 12.4 million barrels of oil equivalent as of June 30, 2015. The proved reserves ratio is 80% oil and 20% natural gas liquids. One of the fairly unique features of Evolution Petroleum is the lack of major debt in its balance sheet. Evolution Petroleum maintains a very conservative and risk-averse financial structure by keeping debt at or as close as possible to zero. This financial structure provides the company with safety during economic downturn and allows the company to remain flexible when making business decisions. We use the PV10 valuation method to arrive at our rating of market outperform for Evolution Petroleum. Our PV10 model uses two sources to determine the projection of prices and production. The Birkenrode price tag was used to determine the future prices of oil, and production estimates are calculated based on Evolution Petroleum's management guidance. After calculating cash flows, we discount them by 10%. We arrived at the stock price of $7 per share by averaging the 5-year net asset value PV10, the 7-year net asset value PV10, and the 15 times EBITDA calculations. Several drivers influence companies in the oil and gas industry, the most important being commodity prices. Revenues are directly tied to the fluctuations in prices of oil and natural gas, which are dependent on a variety of factors. Government regulations and international governing bodies can also affect the operations of such firms. From a global perspective, it is important to understand the leverage that the Organization of Petroleum Exporting Countries, or OPEC, has on crude oil prices. OPEC can manipulate hydrocarbon prices by controlling production outputs in its member countries, which have a significant impact in global supply. Competition in the upstream E&P market revolves around access to capital and the high demand for mineral interests. Evolution Petroleum is a relatively small-sized company with regards to market cap and does not have any new immediate prospects for purchase of mineral interests, although management has not ruled out the possibility in the future. The enhanced or tertiary oil recovery industry specializes in techniques that allow E&P companies to recover 30 to 60% or more of their reservoir's original oil in place, as opposed to 10 to 40% utilizing primary and secondary techniques. These techniques include thermal recovery, chemical injection, and gas injection. Evolution Petroleum and the Delhi field operator, Denbury Resources, specialize in gas injection. In this method, carbon dioxide is pumped into oil-containing rock formations, acting as a solvent and improving its flow rate. The gas can also expand, pushing the hydrocarbons to the wellbore. There are not many companies that specialize in this kind of recovery. However, CO2 EOR technique is the one attracting the most market interest. We based our peer analysis on similar business operations, comparable market cap, geographic location, and position within the industry as upstream E&P companies. We therefore chose Approach Resources, Callon Petroleum, Denbury Resources, Saratoga Resources, and Yuma Energy as Evolution Petroleum's peers. Our metrics for comparison are market cap, price-to-earnings ratio, price-to-book value ratio, enterprise value to EBITDA ratio, debt-to-equity ratio, return on equity, forward annual dividend yield, and proved reserves in thousands of barrels of oil equivalent. As shown on this table, Evolution Petroleum has a market cap that is well below the average of its peers, but it is the only company making a positive return on equity and dividend yield. Evolution Petroleum also boasts the highest price-to-book value and an above-average enterprise value to EBITDA. Evolution Petroleum faces operational, regulatory, and financial risks, which are common in companies in the oil and gas industry. Market volatility will always be a substantial risk factor for any oil-producing company. A sustained low-price environment in the commodity can break even the financially healthiest of companies, as costs become prohibitive to operate. The company's team is composed of only 9 essential and highly skilled employees, which contribute to the daily functions of the corporation. They're responsible for facilitating deals, guiding operations, and obtaining capital for the company. This poses a risk, as the company could face major operational consequences from the loss of any of these key personnel. Additionally, the Delhi field is Evolution's most significant asset and accounts to almost all of the company's overall revenues. Any unexpected issues within the field or its operator could impact the firm significantly. An example of such is the June 2013 environmental event, where oil leaked into the surrounding area. The leak led to a suspension of operations as well as a lawsuit from the operator, Denbury, which has recently been dismissed. Another significant risk to Evolution is its proprietary GARP technology. This artificial lift technology can potentially offer extended life for many horizontal and vertical wells, and the company is in the process of its commercialization. However, GARP has yet to be an industry-accepted solution in the tertiary recovery industry, as it is in the early adoption stage of the commercialization process. Evolution fares well in terms of financial risks because of its zero-debt capital structure. The company's leverage and liquidity ratios are much higher than its peers because it is unlevered. Lastly, the oil and gas extraction and production industry is heavily regulated. Changes in legislation or additional regulation are likely to increase operational costs. We now present to you our investment thesis to conclude the presentation. Evolution benefits from being a non-operating company in the tertiary EOR niche of the upstream E&P industry. This allows them to avoid capital expenditures and provides for constant production levels with gradual rates of decline, which makes it financially flexible to cope with low oil prices. The fact that Evolution maintains such a risk-averse financial structure is an excellent feature that protects the company in times of hardship and enhances their ability to expand their operations in the future. Regardless of low oil and gas prices, the Delhi field is expected to continue experiencing growing recovery and production through 2020, before its production starts to diminish. This is a promising measurement for the future of Evolution Petroleum. GARP is a promising technology with very substantial economic possibilities, but it doesn't come without its risks. The technology may or may not see substantial usage within the industry, especially at today's low commodity price environment. Evolution's management is currently reviewing the role this technology will play in the future of the company. Having reached the reversionary interest with Denbury, and with oil prices likely to recover over time, Evolution will be able to continue to see healthy cash flows and honor its commitment to pay dividends to its shareholders. We would like to thank you for listening to our analysis of Evolution Petroleum Corporation. If you would like more information, you can find the full report at www.birkenroad.org.